Guys, it's no secret that the world is in a state of uncertainty. Markets and economies all over the world are struggling. People are in financial distress. Businesses really don't even know what they're going to do from day to day. So, what is trading in the market going to look like for 2023? Well, guys, in this video, I'm going to give you 7 tips to trade successfully in 2023 right after this intro and disclaimer. Let's go.
Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Have faith in your mind, have faith in your grind, invest in yourself, transform in your time. Trading get paid, trading get paid, trading get paid, trading get paid, oh yeah, trading get paid.
What's up, guys? This is Joe Junta, and it's time to trade and get paid. In 2023, how we trade is going to really need to be structured more than before. It's going to require more structure. You're going to need to basically find ways to reduce risk, limit exposure to like adverse conditions in the market that are going to, potentially cause harm or loss. So you're going to need to limit that exposure to adverse conditions. So here are 7 tips for trading in 2023. Number 1, risk management is the most important thing to focus on. Risk management, guys, is the most important thing to focus on. Risk management is bigger than your trading strategy. It's bigger than whatever indicator you're going to use or the next big thing. Risk management is the most important thing that we have in Forex trading. What you're doing is you're limiting your risk. You're limiting your exposure to things that can cause potential loss, right? So before we can make money, we got to know how to not lose money. And that's where risk management comes in. You're going to need to understand risk to reward. Your risk to reward is so important. Understanding that you're not putting more at risk than there is for a potential gain in any one trade. You're going to want to make sure you're following all your rules. Make sure that, whatever those rules are, if it's making sure that markets are in a trend, you need to make sure you follow that rule. Don't try to go against your rules and try something new in real money. Anything you're going to do that, is outside of your rules or something that you want to test or try out, do that in a demo account. Do that in back testing and then in a demo account before you put that into live action or real money. You want to limit your risk, reduce your exposure, and you do that by following your rules, making sure that your trading strategy is conservative but yet aggressive in a sense that you're aggressive enough to be able to go after previous structure levels for targets, but you're reducing and making sure that you're reducing that risk by setting smaller stop losses and making sure that those stop losses make sense in conjunction with previous, market structure. I don't want to set a stop tight simply to set a stop tight. I want to go back and look at where previous structure is and make sure that the stop loss makes sense. Number 2, fundamentals will be more impacting than normal. So what I'm saying is we generally do a lot of technical analysis, but right now, especially in 23, as we move forward, fundamentals are going to be more important than ever. Not that technical analysis still is not king and that price action is still not king, but that fundamentals are more impacting than they have been in the past. Normally, when we would talk about like interest rates, we would just avoid interest rate announcements or red folders in the market. And, we would wait till them interest rates are announced, let the market move, and then trade the normality once, the correction comes. But now what's happening is instead of interest rates or inflation rates or job announcements or economic announcements and all of these different things that we treated just as news, now these things, instead of just being economic events, are now economic conditions. So when inflation rates are extremely high, well, guess what happens? Instead of just an inflation rate announcement that is causing, maybe abnormality in the market, now suddenly inflation is a condition of the market, and we're not trading around a red folder, we're trading around a whole condition of inflation. And so what generally happens during inflation is that the speed of a currency will slow down. And so now, instead of being able to, just be quick in and out of a market, you may have to understand when volume is going to come in to a currency or a pair, so that you can trade quickly in and out. If you're a scalper, if you're a day trader or a swing trader, maybe it won't quite as affect you just as much, but just plan to be in trades a little bit longer. So what I mean is that we just have to understand the fundamentals of the market a little bit more than just looking at red folders and avoiding them. We're going to have to understand what interest rates do. We're going to have to understand what inflation is about. We're going to have to understand market orders and money flow overall, really just how the banks are moving money. We're going to need to understand supply and demand zones and institutional levels. Those things are going to matter more than ever before, because it's less about indicators crossing or technicals just happening, and the fundamentals of the current condition of the market are going to either speed up or slow down the inevitable from the technical analysis that you did. Number 3, you must track your trading. You must track your trading. You have heard me say it before, you can't manage what you don't measure. You can't manage what you don't measure. And how can you replicate something if you haven't yet recognized it? I say it all the time. Recognition is the first step of replication. And so the only way you can find recognition in your trading and find habits, both good and bad, is by tracking. You need to be journaling your trades. You need to be taking down every trade that you take, marking it down, why you got in it, your entry, your stop loss, your take profit, the result of your trade, what you were thinking, as much information as you can about each trade, so that when you go back and you look at your record, if you won 5 and lost 5, let's find out why you won. Let's find out why you lost, so that you can eliminate the behaviors that caused you to lose and replicate the behaviors that caused you to win. Number 4 is you're going to have to narrow your strategic focus. So rather than having to focus on multiple strategies and lots of different things in the market, you may need to narrow that down to a couple of specific things. Like, for an example, maybe going forward in 23, you're only going to trade certain chart patterns. Maybe rather than just looking for any pattern, maybe you're going to determine that you're only going to trade head and shoulders and double tops and bottoms. Maybe you're going to, because they're high probability. Maybe you're only going to trade diamond patterns. Maybe you're only going to trade harmonics. Whatever that looks like for you, you should narrow down your focus so that you're not so widely spread in your trading. You should be able to say, I'm only going to enter when pin bars or engulfing candles happen. I'm only going to enter when certain levels of structure are broken. I'm only going to enter the market on trend line breaks. Whatever that looks like for you, that you identify with and that you can recognize easily and find high probability trade setups, that's what you're going to want to do. You're going to want to find things and narrow that strategic focus down to a place where you can have certain and very particular specific rules that allow you to enter the market. See, it's like a pressure washer. So imagine a pressure washer that's on a high setting where the water is coming out, spread very wide. Well, you can wash a car with that. You can, maybe spray off your sidewalk or something with it. But when you put on a tip on the pressure washer, that's what's called a 0 degree. That 0 degree, it comes out as a straight stream. And it's so powerful that now the same pressure washer that you use to wash your car, on this new setting with the new tip on it for the 0 degree, focused and in a streamline, would now peel the paint off of your car, right? Because there is power in focus. We didn't turn up the water in the pressure washer. We didn't change how much pressure was coming into it. We simply changed the focus of where the water was going. And it went from being able to wash a car to peeling the paint off a car. And so what my purpose in telling you this is, when we're widely spread, we're less powerful. But when we come into a very stern and strict focus, we can literally punch holes through walls and be very, very powerful with our focus. So I encourage you to narrow your strategic focus. Number 5, understanding sessions will become more vital. So understanding how price moves during certain sessions is going to be one of the keys, especially for those who are scalpers and day traders, because you're not going to want to trade in sessions where there's no movement in the pair that you're trading. For an example, if you're trading GBP USD, the most volatile or the speed of the market, the volume of the market generally trades during London and into the US session. If you're trading GJ or GBP JPY, you can trade the late Asian session and into London. But if you're trading something like the NAS 100, you're going to want to trade that during the US session. And so each one of these pairs has certain times where there's more volume and more speed and volatility in the market. And that's when you're going to want to know when those things happen. You're going to really want to understand when your pair moves, not just how your pair moves, but when your pair moves, so that you can understand this is the time I should be looking for dynamic trade setups. Number 6, scaling your trades is a great option for securing profits. So we want to really institute ways to get in and out of trades profitably. We don't want, again, it's kind of like the risk management we talked about. We want to limit our exposure to risk. And when we're talking about scaling, using a trailing stop loss or securing partial profits along the way is a great way to limit that exposure. It's a great way to put money in the bank without exposing that money to risk. So you're going to enter a trade on whatever rules you have, and you have a certain stop loss. Well, at some point as your trade moves into profit, you're going to want to move that stop loss into profit, or at least to break even, so that if the trade turns against you, the worst thing that can happen is that you made a little bit of money, or that you broke even and now you don't have any risk involved in the trade. You can't lose money. And so using a trailing stop is a great way to scale out of a trade. Another thing is to secure partial profits along the way. You'll notice on your MT4 or whatever platform you're using that when you go to close the trade, there'll be an option to where you can close a percentage of the trade. So let's say you're using a $10 lot size, and now your trade is doing really well. You're in profit, and your trade is extending. And so now maybe what you want to do is, maybe you don't want to trade the whole, you don't want to take the whole trade out, but maybe what you want to do is change that from a $10 lot size to a $5 lot size. So essentially taking half of your trade and putting it in the bank, so that now you have guaranteed that you have at least made some money during this trade. So now if it goes against you, the worst thing that could happen is you already have money in the bank. So as the trade continues to go, maybe you take that $5 position and change it into a $3 position or a $2.50 position, so that along the way, as your trade starts to lose steam or starts to gas out, or in other words, as the market starts to exhaust in that direction, you have already secured most of your profit, and the remaining portion of the trade that you have going is so small and far less than what you have already put in the bank. That's a great way to exit a trade in stages. Number 7, invest in furthered education. YouTube is great, and you're going to learn some good strategies, and there's some people out there that may talk about some risk management. You're going to learn some good things on YouTube. However, I would encourage you to invest in your furthered education. You hear me say it all the time, invest in yourself before you invest in the market. Before I put my money in the market, I should put my money into myself. I want to make sure that I am a good, professional, solid trader before I really put a lot of my money at risk. And so It's kind of like what people say, you know, you want to learn from your mistakes. Well, here's the problem with that. For me to learn from my mistakes, then I have had to have had a mistake, and it probably cost me something. So, and that's inevitable. You're going to have mistakes, and hopefully you can learn from them. But what's better than learning from your mistakes is to learn from others' mistakes, because learning from others' mistakes is less expensive. I can go into the market and make a mistake myself, and probably I'm going to take a loss. And whatever that loss cost me, that loss becomes a lesson, and that lesson just cost me the amount of whatever it was I lost. So if I lost $100 in that trade, then that loss, that $100 I lost, is what I paid to learn that lesson. And if you start paying for lessons with every loss, that can get pretty expensive pretty quick. So if you lose 2 or 3 trades in a month where you've lost $100 and $50 and $200, you know, you've spent several $100s paying for lessons through your losses. But a different way you can do that is by going in and paying for the experience of somebody else who's already taken those lumps, already taken those losses, and has already paid for those lessons. And you can purchase a course, go online and do different market courses that will allow you to learn from the experience of people who've already done it. And majority of the time, that's going to be far less expensive than taking those lessons yourself or taking those losses yourself. So I would encourage you to invest in furthered education, and it will take your trading to the next level. If these tips help you to prepare for trading in 23, go ahead and like this video. I hope that it brought you a lot of value. If you feel like more content like this would help you, hit subscribe, hit that bell. It would not only help you, but it would help me to get the video out to more people. And then do this, comment below, give me your thoughts. Which one of these tips do you feel will help you best in your personal trading? Out of all the tips we talked about today, which one is going to help you in your personal trading the most? And guys, check this out. If you want to do these markets together in 2023, then what I want you to do is go and join me at my website, tradinggetpaid.com, and become a student, jump on board, and let's take your trading to the next level. I'll see you in the next video.